In the world of asset management, there are two kinds of models you can use. Traditional models are based on equity or fixed interest securities. Alternative models, however, are different. They aim at earning positive returns whether markets are on their way up or down. The foremost alternative models work with managed futures, also known as CTAs. Modern portfolio selection theory requires professional managers to maximize the risk and/or reward ratio. They do this by selecting the right assets. Let's look at the example of a portfolio built up out of traditional assets. We know that there's a certain efficient frontier we can aim for with that portfolio. But if we include CTAs or managed futures, we can push the efficient frontier toward a scenario of better rewards, thus achieving the holy grail of asset management: higher returns at the same level of risk, or steady achievement of our target returns at a lower risk than before. The main reason for the improvement is the good correlation between CTAs and other assets, especially equity securities. As we have seen time and time again, managed futures tend to display positive behavior when equity securities are showing significant losses. When there are widespread drops in stock markets, CTAs are by nature quite likely to mitigate the negative impact. Thanks to their ability to adapt to different scenarios, managed futures have become highly appreciated. As time goes on, more and more portfolios are including managed futures in search of improved efficiency. At CM Capital Markets, we're familiar with the many advantages of models like this. Our quantitative analysis department is thoroughly experienced in crafting strategies designed to improve efficiency ratios. For proof, just take a look at our NS SELECTION CAPITRADE fund and its great performance. The model we propose is a trend-following CTA. That means it feeds off markets' natural inefficiency. If markets were efficient, as soon as information affecting the valuation of an asset came to light, the asset's listed price would immediately adjust to the new circumstances by rising or falling to its new fair value. After that, its listed price would remain steady until the next event came along to change the asset's price. But we know it never happens like that. We see it every day. Information, valuation, and execution operate asymmetrically, making prices go up and down in a diagonal pattern. The result is what we all know as trends. This is the inefficiency the model feeds off and the foundation for the deployment of the model's quantitative strategies. These strategies can detect trends as they build up, develop, and peter out, and turn them into signals telling us when to go into a market and when to get out. At CapiTrade, we use over 700 quantitative strategies, each developed to perform a specific function. It's the combination of them all together that really gives us our competitive edge. In addition, unlike shares, futures give us the chance to turn a profit on both bullish and bearish trends. Futures markets are more likely to get positive returns no matter how the market behaves. One of the foundations of the model, actually its main characteristic, is the fact that the model is widely diversified. It invests in all the leading futures markets of the world economy simultaneously: equities, rates, currencies, energy, metals, soft, grain, and meat. Trends are taking place in all of them, and in all of them the fund has strategic abilities, pinpointing exactly when to get in and when to get out. To guarantee the model's scalability and offer a daily net asset value, the fund makes sure all these futures markets are electronic and are liquid enough to support 100% automated trading. Every time a strategy changes its position, it triggers a process that eventually determines the exact size of the position that should be taken. The process is based on the following 4 variables. 1. The capital being managed. 2. The position of the strategies. 3. The volatility of the market where the position is going to be changed. 4. And the correlation of that market with all the other markets. If a market's volatility rises, the size of the position associated with that market goes down in proportion. If the correlation falls, the size of the position increases. If the capital being managed increases, the size of all positions increases in proportion. It all takes place in milliseconds and is completely automated. Real-time processing and control of these 4 factors enables us to hold the fund's volatility very close to our desired target of 15%, and at the same time, keep all the markets even in terms of risk. In addition, All processes go on in real time 24 hours a day, 5 days a week and are monitored constantly. To handle all these calculations in the time required, we have the latest in technology and redundant infrastructure. NS Selection CAPITRADE CTA is a fund designed by the CM Capital Markets team of analysts and involves firms of recognized prestige, all of which are specialists in their fields. And it's all just as transparent as can be. Any investor is just a click away from getting all the real-time information needed to track the model exhaustively. These are the reasons why NS Selection CAPITRADE CTA received the 2014 award for Europe's Best CTA Managed Future. This great honor confirmed that our model, with its rigorous advanced quantitative analyses, its understanding of the virtues of diversification, its precise risk control, and its cutting-edge technologies, is one of the most important models out there.